Now let's talk about securities issued by federal agencies. So essentially, you can think of these federal agencies as semi-government entities. In the United States, there are two broad categories for these federal agencies. One category is the federally related institutions, and the other category is the government-sponsored enterprises. Now, examples of the federally related institutions include Ginnie Mae, which is often referred to as GNMA. So that's the official name, but it's referred to as Ginnie Mae, and also the Tennessee Valley Authority, or TVA. So two major examples of federally related institutions. And then we also have government-sponsored enterprises. The major examples of this are Fannie Mae. So Fannie Mae, Freddie Mac, Sallie Mae, these are all examples of government-sponsored enterprises. Now, since these entities are essentially backed by the government, we can say that they have very little credit risk. So we can't say zero credit risk because they are not the government, but since they have the backing of the government, we say that they have very little credit risk. And this actually was proven in the 2008 financial crisis, where some of these institutions were at the heart of the crisis and they were bailed out by the US government. These securities issued by federal agencies are debentures, and you might see this in other parts of the course. But a debenture is a security which is essentially an unsecured bond. In other words, there is no collateral that backs up these securities. And again, in a sense, since these are government-backed entities which are issuing securities, they can get away with not having any collateral. So continuing with US agency-oriented securities, a major category of securities issued by US agencies is the mortgage-backed securities. To understand mortgage-backed securities, we are first going to get a quick refresher on mortgage loans. We will then talk about mortgage pass-through securities, and then we will cover collateralized mortgage obligations. So first, a quick refresher on a mortgage. Let's say that we are considering a bank that issues a $100,000 30-year 6% mortgage. So what are the payments then that this bank will expect? So in other words, the bank is making a loan of 100,000, and that loan/mortgage is a 30-year 6% mortgage. So for a mortgage, when the bank is making the loan, it is a homeowner who is borrowing this $100,000, and he needs to then make payments over 30 years. And in a typical mortgage, the home will serve as collateral. And from the bank's perspective, since the bank is making the loan and then will be receiving payments, from the bank's perspective, this mortgage is an asset. Obviously, from the homeowner's perspective, it is a liability. It's a loan, and for him, it's a liability with the home as collateral. Now, you've seen this many times, and if you know this well, then you can just skip to the next slide. But for those who need a refresher, just listen on. So how do we calculate the cash flow? The idea is straightforward. Let's say, like any typical mortgage, we need to make monthly payments. So the homeowner makes monthly payments. So for a 30-year period, monthly payments means that N is equal to 30 multiplied by 12, which is equal to 360 payments. The interest rate for each month is equal to 6 divided by 12 months in a year. So interest rate per month is 0.5%. The value of the loan, which is the present value, is equal to 100,000. The future value is 0 because over the 30-year period this loan will be completely paid off. So when we compute the payment, what we should get is 599.55. So this means that for this loan, the homeowner will be paying the bank 599.55 every month. So the beginning principal is 100,000. The way we calculate the interest portion for the first period is the beginning portion of the principal multiplied by the interest rate, which is 6%. So the initial amount of interest is 6% of 100, actually I'm sorry, it's 6% divided by 12, so 0.5% of 100,000, which is 500. The principal portion would be the amount, which is 599.55 minus the interest of 500. So this gives us 99.55, and the remaining principal after this principal is paid off is 99,900.45. So this is the remaining principal. Now we can do this calculation for all 360 periods, and at the end we should have a principal equal to 0. So again, as a recap, from the perspective of the bank, this is an asset, and the bank can expect to receive this payment every period. Now with typical mortgage loans, the homeowner has an option to prepay. Prepay simply means that the homeowner can make a payment in excess. So if a homeowner makes a payment in excess of 599.55, that extra amount is called a prepayment, and what that prepayment does is reduces the amount of outstanding principal, and if the principal outstanding goes down, then the interest portion also goes down. But the key point to remember is prepayments typically are allowed, and those prepayments reduce the duration of the mortgage and also reduce the amount of interest that is received by the bank. Let us now talk about mortgage pass-through securities, which are the simplest category of a mortgage-backed security. And in simple terms, this is how it works. Let's say you have a large bank. So this is our bank, and let's say that this bank issues mortgage loans, and let's say we have your homeowners over here. So these homeowners receive mortgage loans from the bank, and they in turn make mortgage payments to the bank. So similarly, we have lots of homeowners who are making mortgage payments to the bank. Now I'm going to base this discussion on Exhibit 7 in the curriculum, but if you follow with the curriculum, that's great, but you should be able to understand this example even without the curriculum. So let's, for simplicity, say that each one of these loans is a $100,000 loan, and let us say that we have 2,000 such loans. So on the bank's portfolio, you have all the way down to loan 1, loan 2, down to 2,000. So the total mortgage portfolio of this bank is $200 million. So where does the 200 million come from? It's 2,000 loans, where each loan is worth 100,000. So the total loan portfolio for this large bank is 200 million. Now let's say that this bank sells this entire loan portfolio to one of the government agencies that we were talking about. So all this loan portfolio of 2,000 loans, so loan 1 down to mortgage loan 2,000, so this portfolio of $200 million is sold to a agency. Now all the cash flows that we talked about that are coming from the homeowners, so the mortgage payments from the homeowners, are now coming to the agency, because the agency owns the mortgage loans or these assets. So let's say that the agency now issues a certificate, and this certificate is what we call the mortgage pass-through security. So this certificate is now sold to investors, and for simplicity again we will say that there are 2000 such certificates. So if there are 2000, let's say there are 200,000 certificates or mortgage-backed securities that are issued against this portfolio of 200 million. So that would mean that the par value for each certificate is 1000. Now what's this investor getting? So the investor who holds this mortgage pass-through security, what is essentially happening is that the cash flow that is coming from this mortgage payment or from all these mortgage payments is flowing through to the holder of the mortgage pass-through security. And effectively the payments that he is getting are in three categories. So this investor is getting interest payments. So if you recall from our earlier slide, when mortgage payments are being made, there is a interest component, there is a principal component, and then there is a prepayments component. Now if there are no prepayments, then effectively this investor over the 30-year period will get back his share from all these payments. However, if there are prepayments, then obviously each investor on a pro rata basis will get his money back faster. So what happens in a mortgage pass-through security is all this money simply flows through to the investor, and if interest rates go down and homeowners refinance and pay off these loans faster, then essentially the investor in this mortgage pass-through security gets his money back sooner. So if you recall from the last discussion, the prepayment risk is relatively high because whenever interest rates go down, there will be prepayments, so the investor in the mortgage pass-through security will get his money back faster. So what was the advantage then of doing this? The way you can think of this is as follows. Let's say that we didn't have this entire structure in between, and a given investor simply invested his money by lending money directly to the homeowner. So if this had happened, there are several issues. One issue is that if this particular homeowner defaults, then this investor takes the entire hit. So that's one issue. The other issue is if for some reason this homeowner makes prepayment, so he suddenly gets a huge bonus and decides to pay off the loan, then again this investor takes the hit. So that's the issue with somebody making an investment in just one loan. By pooling together 2000 loans, effectively what happens is that the prepayment risk gets distributed, plus the default risk also gets distributed. So if anybody defaults from here, then one investor does not have to take the overall hit. Another point related to default risk is when you have the government-backed agencies that we talked about, they only buy loans from banks that meet certain criteria, and hence when these agencies issue mortgage pass-through securities or any other amortizing securities, they essentially guarantee or they essentially ensure that the probability of default for the investor is extremely low. So that's why we say that the credit risk is very low. So that is our general idea as far as mortgage pass-through securities is concerned. Sometimes with mortgage pass-through securities, we can break the securities into what's called principal-only strips and interest-only strips. So the holders of principal-only strips will only get the principal component. The interest-only strips will get interest payments. There is more on this, but that material will be covered in level 2. So now let's talk about collateralized mortgage obligations. Now, collateralized mortgage obligations are actually another category of mortgage-backed securities. They are a little more complex than mortgage pass-through securities. If you recall, the issue with mortgage pass-through securities was that when we have prepayments, then all investors will get their money faster. What CMOs allow us to do is to redistribute the prepayment risk. It doesn't eliminate prepayment risk, it simply redistributes. Now, how does this happen? This happens through a process called tranching. Now, let's say that we are still continuing with our previous example where we had a total portfolio of 200 million. Now, if this total portfolio of 200 million is divided into three tranches, tranche A, tranche B and tranche C, and we make a rule. So now, and I'll use the numbers in the curriculum. If that's the total value of the portfolio, let's say that the par value for tranche A is 80 million, the par value for tranche B is 70 million, and for C we have 50 million. And in terms of the payments that are coming from the homeowners, so homeowners are paying off their mortgage payments, and in terms of what the CMO investor gets, if we set up a rule both for interest payments as well as for principal payments. So we can set up a rule, and this is just a simplified example. There is a lot more detail on this in level 2. Right now you just need to understand the basics. So a simple example is we've divided that 200 million portfolio into three different tranches. So we can say that A will keep getting interest based on outstanding principal, and all the principal payments that are made first pay off tranche A. So the first $80 million worth of principal payments go against tranche A. Once $80 million are paid, that means that tranche A is paid off and will not be receiving any more payments. Then tranche B, who has been receiving outstanding principal all along, then the principal payments after 80 million go against this par value. So they then go against tranche B. So then we start paying off tranche B. And tranche C again keeps getting interest based on outstanding principal, but tranche C gets principal payments only once tranche A and tranche B have been paid off. So notice how we have redistributed prepayment risk. If there are prepayments, the highest prepayments will go to A. So the prepayment risk is highest for tranche A and it is lowest for tranche C, because the principal that tranche C will get is only after A and B have received all the principal. So the prepayment risk is highest for tranche A and it is lowest for tranche C. Now, effectively what we have done is we've not changed the prepayment risk. All we have done is redistributed, where we have given more prepayment risk to A and less prepayment risk to tranche C. On a related note, because of this, the credit risk obviously is a little bit higher for C than it is for A. So there is a trade-off here. If as an investor you are primarily concerned with prepayment risk, then it makes sense for you to invest in tranche C. If you are primarily concerned with credit risk and don't really mind prepayments, then you will go for tranche A. But overall, what has this whole CMO done for us? What are the motivations? One, as I have mentioned before, we allow the prepayment risk to be redistributed by creating these different tranches. The other is we also lower cost of funds. Why? Because as I just alluded to, we can have different kinds of investors. Some investors are really averse to prepayment risk. so they would rather invest in C. And those who are averse to credit risk but don't mind prepayment risk as much will go with tranche A. So essentially, by creating different tranches, we are giving different investors what they want, and by giving investors what they want, we can essentially lower overall costs of funds, because investors would then be willing to give us more money. When investors pay more for these securities, that means the yield or the cost of funds is lower. Again, if you are confused about this, don't worry. As long as you know these basic points, that's good enough for now. This material is covered in immense detail in level 2. So I think at level 1, just knowing the basic points is good enough. And if you are to remember one point related to CMOs, it is that CMOs allow you to redistribute prepayment risk through a tranching mechanism.